This briefing outlines a novel crypto-backed debt pool concept inspired by a leveraged XRP ETF. The proposed pool would strategically combine stable stocks and volatile XRP with 2x leverage, aiming for 5 to 15% returns through issued debt tokens. Whale participation is intended to provide significant initial capital and liquidity, while cross-chain bridges would facilitate XRP movement for DeFi activities. Transparency through blockchain ledgers and regular audits is emphasized, alongside acknowledging inherent risks such as leverage amplification, whale influence, and potential security breaches. Ultimately, this high-risk venture seeks to bridge traditional finance and decentralized finance, offering substantial potential gains alongside considerable loss possibilities.
Subject: Analysis of a proposed crypto-backed debt pool inspired by the Teucrium 2x long daily XRP ETF XXRP. 1. Executive Summary. This briefing document analyzes a proposed crypto-backed debt pool that draws inspiration from the structure of the Teucrium 2x long daily XRP ETF XXRP. The pool aims to generate returns between 5% and 15% by leveraging a combination of stable stock assets, S&P 500 ETFs, and the volatile cryptocurrency XRP with a 2x leverage factor. The design incorporates significant participation from whales, utilizes cross-chain bridges for liquidity, and emphasizes transparent accounting through a blockchain ledger. While the pool presents potential for high returns, it also carries substantial risks associated with leverage, cryptocurrency volatility, reliance on whales, and the security of cross-chain bridges. 2. Background and inspiration. XXRP context. The proposed debt pool model is explicitly inspired by the Teucrium 2x long daily XRP ETF XXRP. This ETF, hypothetically launched on April 8, 2025, on the NYSE Arca with the ticker XXRP, serves as a key reference point for understanding the leveraged exposure to XRP. Key features of XXRP provides 2x daily XRP price exposure through the use of swap agreements, carries a 1.85% fee, experienced a $5 million debut volume, is characterized as a high-risk, short-term trading tool. The inclusion of the XXRP context highlights the inherent volatility and speculative nature that the proposed debt pool seeks to incorporate, albeit within a broader, diversified framework. 3. Proposed debt pool design. The core of the proposal involves a $1 billion pool strategically allocated between traditional stocks and XRP, with a layer of leverage applied. Asset allocation and leverage. 50% stocks, $500 million S&P 500 ETFs, represents the stable and positive return component. 50% XRP, $500 million, represents the volatile and high-potential, high-risk component. 2x leverage to $2 billion amplifies both potential gains and losses based on the underlying asset performance. Debt token issuance. The pool issues 5% yield debt tokens on Ethereum, providing a fixed return to token holders. Performance expectations. Stocks, expected to provide 7–10% returns, offering stability. XRP, expected to drive upside with potential for 6 to 7% daily gains, but also carries the risk of significant drops, as evidenced by 11.2% weekly drops. Rebalancing. A mechanism for rebalancing maintains 50-50 allocation between stocks and XRP, crucial for managing risk and leverage exposure. Management and fees. Managed by a department DO. Charges a 1.5% fee. Transparency. Utilizes a blockchain ledger to ensure complete books and transparency. Subject to audited quarterly financial reviews. 4. Role of whales. The proposal envisions significant participation from large investors, whales, who play a crucial role in capital provision and potentially market influence. Whale contribution. Expected to contribute 60%, $600 million, $300 million stocks, XRP, to the pool. Whale incentives. Offered 6 to 8% yield, a premium over the standard debt token yield. Receive governance tokens, granting them a degree of influence over the pool's operations. Subject to 90-day lockups on their investments. Potential impacts and risks. Boost liquidity, providing substantial capital to the pool. May spike XRP 10 to 20% due to the significant investment. Risks of dumps or control, highlighting the potential for market manipulation or concentrated decision-making. 5. Cross-chain bridges for liquidity. To facilitate the integration of XRP within the broader DeFi ecosystem and enable trading activities, the pool intends to utilize cross-chain bridges. Purpose: enable XRP transfers for DeFi trading. Top contenders. Lists several prominent bridges including dBridge, $996 billion TVL, Synapse, Stargate, Rhino.fi, Orbiter, Allbridge, Sealer Seabridge, Hop, Portal, Across. Technical considerations. The bridges are expected to support XRP, WXRP, be audited, and offer low fees. YIX, potential outcomes, scenario analysis. The briefing outlines 3 potential scenarios based on the performance of the underlying assets. Bullish scenario: stocks plus 5%, XRP plus 20%, Waji 12.5% return, $250 million, pool grows to $1.5 billion. This scenario demonstrates the potential for significant gains when both asset classes perform positively, amplified by leverage. Neutral scenario: stocks plus 3%, XRP 10%, 3.5% loss, $85 million, pool at $900 million. This scenario illustrates the impact of XRP's volatility potentially offsetting gains from the stock component, leading to a net loss. Bearish scenario: stocks 5%, XRP 20%, at here 12.5% loss, $265 million, pool at $600 million. This scenario highlights the significant downside risk when both asset classes decline, magnified by the 2x leverage. 7. Key risks. The briefing explicitly acknowledges several critical risks associated with the proposed debt pool. Leverage losses, emphasizing that the 2x leverage will amplify both gains and losses. Whale exits, the potential for large investors to withdraw their capital, impacting liquidity and potentially triggering price drops. Hacks, 80% 2024 hacks from access control. A significant concern for DeFi protocols and cross-chain bridges, with access control being a major vulnerability. SEC bans, regulatory risk associated with cryptocurrencies, particularly XRP, which has faced scrutiny in the past. 8. Important considerations. This section delves deeper into the implications of the pool's design and the broader market context. Leverage amplification. Leverage amplifies gains, losses, like XRP. This reinforces the high-risk nature of the pool. Stocks mitigate XRP's volatility, but liquidations loom, suggesting that while diversification helps, significant downturns could still lead to severe consequences. Whale centralization. Risk. Whales scale pool but risk centralization. While large investors provide capital, their influence could lead to governance challenges and potential market manipulation. Bridge security. Bridges unlock DeFi, but hacks threaten. The reliance on cross-chain bridges for liquidity introduces a significant security vulnerability. Regulatory alignment versus XRP usage. Transparent ledger aligns with regulations, but XRP's declining usage raises doubts. While transparency is a positive attribute, concerns about the fundamental utility and adoption of XRP remain relevant. 9. Conclusion. The proposed crypto-backed debt pool represents a high-risk pool with the potential to innovate TradFi DeFi, offering a potential yield of 5-15% or losing 50-100%. The briefing concludes that this type of investment is suited for risk-tolerant traders and requires audited bridges and ledgers to mitigate some of the inherent risks. The success and sustainability of the pool will heavily depend on the performance of both the stock and XRP markets, the behavior of large investors, the security of the chosen cross-chain bridges, and the evolving regulatory landscape.
You know how we like to cut through the noise. Today, we're diving into something pretty interesting. You flagged a new kind of crypto-backed debt pool.
Yeah, it definitely caught my eye. It's this ambitious attempt to link up traditional stocks with crypto using leverage.
Right, trying to bridge those two worlds. So let's break it down. We're looking at a $1 billion pool, basically. Half is in, standard S&P 500 ETFs, the familiar stuff.
Right, the stable part.
And the other half, XRP. But here's the twist 2x leverage on the whole thing.
Exactly, doubling down, essentially, which is inspired by that new ETF, right? The Teucrium 2x long daily XRP.
Yeah, XRP. That just launched April 8th, 2025 on NYSE Arca.
And it does the same thing, gives 2x the daily XRP price movement using swaps. It's definitely a high-risk, short-term kind of play.
And pretty pricey, a 1.85% fee. Started with about $5 million in volume. Shows some interest, I guess.
For sure. There's appetite for leveraged crypto exposure.
So the big question for our deep dive today is, how does this pool plan to hit those 5 to 15% returns mixing stable stocks with volatile XRP?
And what's the role of the big players, the whales, and this cross-chain tech they need?
Let's dig into the design first. That $1 billion gets leveraged up to $2 billion.
That's the plan. $1 billion in stocks, $1 billion in XRP notionally, and they're issuing debt tokens, interestingly, on Ethereum.
Debt tokens. Aiming for what, a 5% yield for the token holders?
Yeah, that seems to be the target. The idea is the stocks provide a base, maybe 7–10% returns, hopefully.
The anchor.
While the XRP is the, let's say, growth engine, could jump 6–7% daily.
Or drop. We saw that 11% weekly fall mentioned. Ouch.
Exactly. So they need rebalancing, constantly adjusting to keep that 50-50 split, probably automated.
Makes sense. And who runs this? A DAO or some other group?
Could be a dedicated department, could be a DAO. They'll take a 1.5% management fee. And transparency is supposedly key, blockchain ledger, quarterly audits.
Okay, now these whales, you mentioned they're crucial. How much are they putting in?
The sources suggest around 60%. So $600 million of the initial billion. $300 million stocks, $300 million XRP.
Wow. What's their incentive? Just the potential gains.
They get a sweetener, a higher yield, maybe 6 to 8%, plus governance tokens, so they get a say in how things run.
If there's a catch.
Yeah, a 90-day lockup on their funds. Can't just pull out instantly.
So their involvement provides scale, liquidity, maybe even pumps the XRP price a bit, like 10–20% spikes.
Potentially, yeah. But it's also a risk. What if they coordinate an exit? A big dump could crash the price or give them too much control.
Right. And moving all that XRP around for trading or DeFi that needs these cross-chain bridges.
Absolutely. To get XRP onto other chains where the action might be, often as wrapped XRP or WXOP.
Well, we saw some big names there. D-Bridge, nearly $10 billion TBL. Synapse, Stargate.
Yeah, quite a few established players. They handle the transfers between different blockchains. Ideally, they're audited and fees are low, which is important for the pool's costs.
Okay, so let's game this out. What are the potential outcomes depending on the market?
Well, the sources laid out a few scenarios. Best case, stocks up 5%, XRP rockets 20%.
With 2x leverage, that's looking good.
Yeah, about a 12.5% return. The pool grows by $250 million.
Nice. But what if it's flat or mixed?
A neutral scenario could be, say, stocks up 3%, but XRP drops 10%. Then you're actually looking at a loss.
Uh-oh, how much?
About 3.5% down, the pool shrinks, maybe loses $85 million or so.
And the nightmare scenario, bear market.
If stocks drop 5% and XRP tanks 20%, well, with leverage, that's a roughly 12.5% loss too, a $265 million hit. The pool value could drop significantly.
Yikes, that really highlights the risks. The leverage magnifies everything, just like with that XRP ETF.
Totally. And liquidation is a real threat if values drop too fast. Plus the whale exit risk we talked about.
And security. Hacks are always a concern in crypto. What was that stat? 80% of 2024 hacks involved access control.
Yeah, huge vulnerability. Bridges themselves can be targets. And then there's always the regulatory cloud. Could the SEC step in?
So many factors. It feels like leverage is the big double-edged sword here.
It is. Stocks help smooth XRP's bumps, but don't stop liquidations. Whales give scale, but bring centralization risks. Bridges enable cool stuff, but add hack risks.
And even with a transparent ledger, there are still doubts about XRP's long-term use case, right?
Background noise is always there, yeah.
So, wrapping this up, It's a high-risk, high-reward proposition. Could be innovative, blending TradFi and DeFi for potentially great returns.
Or it could crash and burn spectacularly. Losses could easily hit 50%, maybe even more in extreme scenarios.
Definitely not for the faint of heart. Seems like robust audits for the bridges and the ledger itself are absolutely non-negotiable for this to even have a chance.
Couldn't agree more. Due diligence is paramount.
It really makes you wonder, though, are these leveraged hybrid models the future of investing? And what's the real cost of chasing those amplified returns when you factor in these complex, interconnected risks? Something to chew on.
Definitely food for thought. A fascinating space to watch.